Okay, let's get in more thoughts from Symphony. The management joins us live on the show to talk about the numbers and the outlook ahead. The PAT number was impressive, 27%, but I think the sales number is something that probably might just worry people a bit because of the standards that they have set. Nrupesh Shah, ED of Symphony, joins us right now from Ahmedabad. Nrupesh, thanks so much for joining in. Let's talk about the top line. You know, I would believe that quarter 4 is a really strong quarter for Symphony, and therefore the top line growth will come in. It has come in only 10%. Is it because the volumes have lagged a little bit in the quarter, or are there other reasons for the same?
No, as such, financial year 15-16 for us was 9 months because of new company law. So March end was the third quarter, not fourth quarter, unlike past years. So you are right, in June quarter volume has to be higher, but in March quarter nevertheless, volume as well as top line has grown by about 10%. And as far as PAT on standalone basis is concerned, in the last quarter has gone up almost by 28%.
So the question is about sustainability, and you know, your raw material costs have been under check. What's the outlook that you could give to investors on margins then?
No, our EBITDA margin already on a higher base has already improved by further 300 BPS, mainly on account of one, of course, softening of raw material prices. Second is an economies of scale. Third is a model mix. And fourth is operational efficiency. And we expect that we should be in a position to maintain the same margin even in June quarter.
Nrupesh, I still come back, irrespective of whether it was Q3 or Q4. I'm just looking at what you did in the quarter gone by. Q2, you had a volume growth of 18%. Why is it that Q3 has shown a volume growth of just 10%?
Yeah, in Q3 you are right, volume growth has been 10% vis-a-vis 18 or 19% in earlier 2 quarters. But as we have maintained in the past, we never look the business on quarter-to-quarter basis. We don't even look on a year-to-year basis. It is more on a CAGR basis. So year as a whole, our top line has grown by 19%, and PAT, excluding exceptional item, has grown by 31%, and with exceptional item, it has grown by 41%.
Having said that, you know, I'm not saying that we look at every quarter's performance, but what's the new normal? I mean, okay, what's the guidance that you're leaving out? What do you think? Maybe not be a formal guidance, but what's the expectation on volumes for FY17?
Sure. So in medium to long term, not on quarter-to-quarter or year-to-year basis, we maintain that Symphony should grow 20-25% CAGR basis on consolidated.
20-25% volume growth will happen in FY17?
In particular, that is the current quarter which is underway. Month of April has been pretty good, especially in southern India and eastern India. In fact, in many parts of southern India and eastern India on YOY during this month, we have registered 100% plus growth. But as far as the current month is concerned, that is in the month of May, where typically sales is contributed from northern India and central India. So far it has been muted, but now there also heat is picking up, and summer is likely to be prolonged. So we are optimistic even from northern as well as central India in remaining quarter.
What about PAT performance, Nrupesh? I mean, last quarter, you know, I haven't quite looked at whether you've got an other income component this quarter or no, but last quarter you had some other income component boosting profit as well. What has been the scenario, and do you think you will do a better than a 25-30% PAT number as well because of margin expansion in the year?
Exceptional income was at an IMPCO level, because there also we are converting IMPCO into asset-light business model in line with Symphony India. So there some of the real estate we monetize, and about 12 crore was an exceptional income at IMPCO level, which at consolidated level has been reflected at the year-end level. In fact, there still down the line in a year or two, we are likely to monetize some more assets. And as far as EBITDA margin or operational margin is concerned, broadly speaking, we are likely to maintain the current margin, and it's possible that our 25% of overall CAGR growth should be on account of that.
Right. Which are the assets that you're looking to monetize? How much do you propose to raise from that process?
So at IMPCO level, we believe that almost 40-45% of the assets we have monetized, and still about 50 to 60% of the assets, which is mainly in the form of real estate at the prime locality, we should be in a position to monetize. So with that, in fact, in the last year itself, the exposure of Symphony to IMPCO by way of the working capital exposure has almost reduced to half, and we expect it to be negligible or completely reduced in about a year to 2 years time. In fact, by adopting to asset-light business model at IMPCO level, it is also expected that its operational efficiency will improve further, especially at EBITDA level, in the sense its interest and depreciation and also some losses on account of forex should come down, and it will be in a position to focus more on sales and research and development.
Okay, we'll leave it at that, Nrupesh. Thanks so much for joining in, and all the best for the quarters ahead. Thanks for joining in today. That's Symphony with their quarterly call, and the stock just coming off a little bit. The top line growth could have been a bit better, but anyway, just the management confident of 20-25% going ahead. By the way, just need to focus a bit on some other stocks. You know, we were just speaking about Tata Metallics ahead before we went to Symphony, and just look at that move. That stock has really shot up in trade, and I think Tata Sponge, Tata Investments, all of these have moved up along with. So yes, Symphony is done. Now let's get Tata Metallics, Tata Investment, Tata Sponge.